Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 24th of July. I'm Daniel Lam, your host for the podcast. It is all about Japan again. Just when we were talking about the uncertainties caused by the election results, we have a major boost in the form of a tariff deal with the US. Japan's auto sector, which accounts for more than a quarter of its US exports, will see existing tariff cut to 15% from levies totaling 27.5%. Duties that were becoming effective on other Japanese goods from August the 1st will also be cut to 15% from 25%. This is in exchange for a $550 billion US dollar package in US bound investment and loans. Now, the deal was taken very positively by the markets. That trumps over the concerns about the election results. There was a notable spike in the 10-year JGB yields back to the 1.6% level, which was the previous intraday peak that we saw earlier this month. Now, that was during the time when the markets were getting concerned about the outcome of the elections. But the current spike in the yield is a quote-unquote positive spike because of the optimism on the Japan economy from the better-than-expected outcome on the tariff front. This same positive vibe led the Topix index to break out of the narrow range that it has been trading over the past 2 months. And it is testing the peak that we saw back in July last year. The mega banks were the ones leading the way, benefiting from prospects of better economy. And this trade deal is also leading the dollar-yen back to fundamentals, i.e. downtrend. Over the longer term, we continue to have our 12-month target at 140. The yen can strengthen further due to diverging rate expectations between the US and Japan. Domestic investors hold most of the government debt in Japan, insulating the debt burden to some extent from global financial markets. In contrast, foreign investors hold a significant portion of US government debt. Now, what we need to watch out for now in Japan is the effect of inflation. Because the new political situation means we will likely be getting looser fiscal policy. And the brighter economic prospects in Japan can stimulate growth, and that can fuel inflation. The Bank of Japan has been very cautious so far, but this changed situation may warrant a shift in their mindset in order not to fall behind the curve. Will they be up for the task? That is a question that many investors will be observing in Japan in the second half of this year. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.